Hello, and welcome to the November 2023 Economic and Market Update, presented by Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. October saw one more month of market pullbacks across the board as interest rates continued to edge up. The U.S. indices were down for the third month in a row by around 2%, with the Nasdaq doing the worst. International markets also pulled back at around 4% for both developed and emerging markets. Even fixed income was down for the second month in a row. While markets were down, though, the economy continued to chug along. Job growth remained healthy, both consumer income and spending continued to grow, and retail sales were also up sharply. That said, though, there were some signs of slowing in the employment data, and consumer confidence dropped somewhat, influenced by higher gas prices and the continued weakness in the housing market. On the business side, we're also seeing some headwinds. Business confidence reports were mixed, as manufacturing pulled back a bit, although services remained healthy. Better news was that business investment was solid last month, which was a good sign. Overall, though, despite the stresses, we are still in a pretty good place economically. One area we do need to watch, though, is the inflation data, where the improvement may be slowing. While the housing market will continue to pull inflation down, other components may be starting to strengthen again. Again, the news remains good, but there are signs that improvement is slowing. So with the economy solid, the major factors driving markets down this month were twofold: interest rates and war. Long-term interest rates rose further during the month from 4.6 to over 5% before pulling back a bit at month end. As rates rose further, markets have been adjusting their long-term expectations and therefore stock market valuations, which drove the pullback. Also weighing on markets was the Hamas terrorist invasion of Israel and the prospect of a wider Middle East war. It was a difficult month across the board. But despite those very real concerns, there were also some bright spots. Earnings are coming in better than expected this quarter, which is a positive and offsets some of the damage from valuation contractions. Earnings are also expected to keep growing over the next several quarters, which should help. For rates, while they're up, there are also signs they may have stabilized. And if the Fed doesn't raise rates at its next meeting, they're likely close to their peaks. And while September and October can be tough months, the remainder of the year is usually stronger. With a solid economy and with earnings growing, the market foundations are still in good shape. None of this is guaranteed, of course, and risks remain, both here in the U.S. with inflation in the Fed and abroad with the Hamas war, China, Russia, and other problems. But with this many worries seemingly priced in over the past couple of bad months, there is room for a recovery, especially as the fundamentals are still solid. Despite everything, we're still in a pretty good place. That's it for this update. Thanks for watching. Join me in December for the next one, but until then, be sure to check my blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. And I hope you're having a great fall.